Well, the Fidelity Australian Equities Fund recently turned 20 years old. In that time, its return has averaged 11.07% a year. The returns are created by a core holdings of 30 to 50 Australian companies. Now, the skill here is which stocks to overweight and which to leave out altogether. Paul Taylor, a funds management Hall of Famer, has run the $5.5 billion fund since its inception and joins me now. Paul, many thanks for your time.
Thanks, Ross.
Is that the key? Working out which ones to keep in and which ones to drop out?
Look, I definitely think so. You want a diversified portfolio, right? You want more than 30. We think 50, you get too close to the market. So that gives enough oomph in the portfolio to deliver outperformance for clients, but does it in a risk-controlled way. Okay,
so for people watching, investors, they're going to sit there and say, do I start with the stock or do I start with the overall picture of the economy? Which do you start with?
I definitely start with the stock, but you do need to think it within context as well. You do need to think within a portfolio, because I guess the biggest stocks within the portfolio, I'm always looking for like a call option payoff where you've got little downside and good upside if things go your way, right? They don't always, but if they do. That's where you want your bulk of your portfolio. You can have some more stocks that have got a lot of upside, but potentially downside. So you're taking on more risk for a lot more upside, but you don't want them to be big positions in the portfolio.
So here's your top 5 holdings at the moment. Commonwealth Bank, BHP, CSL, Telstra and Suncorp, oddly enough. That's perhaps the aberration amongst those top stocks there. But there's a few stocks you don't have there. You don't have a Fortescue in there, for example. You don't have a Wesfarmers in there.
No.
You know, these are the deliberate bets that you make, aren't they?
Yeah, they definitely. And that you look at that, you know, Wesfarmers obviously a fantastic company, been a great company for a long period of time. We're a little bit concerned about the consumer at the moment. So I think they're obviously quite exposed to discretionary consumer. If we get some weakness through reporting season and weakness in the second half, that's obviously a stock we'd consider.
Okay, so here's some of the other underweight positions you've got. So we see the NAB, you've got other banks, the Commonwealth Bank and Suncorp we mentioned there. You've got Transurban in there as well. And yet Transurban, the recovery after COVID, and certainly where do you have concerns there with Transurban at the moment, why you wouldn't have them in your core portfolio?
Once again, Transurban's been a great stock for a long period of time. It just really comes down to valuation. So a lot is already, we're obviously looking for companies that don't have a lot factored in, where there's little downside and really good upside if things work. Transurban has been a great stock, but a lot is already factored into the share price.
Okay, so the interesting thing is Fidelity, the famous Magellan fund run by Peter Lynch, the values that he had, trying to look for these values. But you've got big stocks here. Do you tend to go down to the mid caps and the smaller stocks to try and chase a bit of oomph for the portfolio?
Oh, definitely. We'll have those big companies, but we'll go, if the opportunity's in small caps, we'll go there. If they're mid caps, we'll go there. If they're large caps, they'll go there.
So you're looking for the famous Tenbaggers that he was always
Absolutely,
after?
absolutely.
You are?
Yes.
So in other words, those things exist. They almost seem like, if you like, the unicorns of the stock market for many people.
They are, but you talked about we've just hit the 20-year mark, which obviously we're extremely happy about. And when we look back over that 20 years, there's actually been a large number of not just 10 baggers, but 20 baggers.
Yes.
And it's sort of surprising, over that period of time, you do the WiseTechs, the Seeks, the Dominoes over 20
the
years.
CSLs over a long period of time.
CSLs, Goodman Group.
Yes.
I mean, there's a lot of stocks that have really, been multi-baggers.
So is the trick here to get on the ground floor, to look at companies that are coming onto the market that have probably got a bit of quality or a bit of a story about them, and to try and start at the beginning and just to hang on?
Absolutely. So if you look at that 20-year period, those companies that have gone up 20 times, their earnings have gone up 20 times. And that's what you're looking for, leverage in that company that they can deliver, earnings. $1 of earnings today is going to turn into $10 of earnings in 10 years' time. That's what you're looking for, and that's the trick.
Okay, so the economy is forecast to slow. We're going to talk about that very shortly. So recession or no recession here, is that a good time to be looking to buy stocks, or is it a poor time to be looking to buy stocks?
I think it's a great time to be looking at stocks, because what we're always really looking for is a stock that's cyclically in decline, but's got long-term structural growth, because they're your opportunities. When growth slows or, potentially a recession in the second half, that's the ideal opportunity, because companies can be negatively impacted by the cycle, by the economic conditions. But if you can see one that's really got a great long-term structural runway and is being valued, it's got a very cheap valuation because of that cyclical decline, that's a great long-term opportunity.
Okay, one very last quick one. Is a company that's not on your list that you're not covering at this time, you're not investing in, is that dead to you, or do you continue to go and talk to that company, monitor them?
No, absolutely. So Ross, we have what we call waterfront coverage. We're meeting the whole market every quarter. You know, we're doing our own earnings, cash flow, valuation, balance sheet model. We're meeting with the company. We're putting an investment rating, and we meet with them whether we like them, hate them, or anywhere in between, because you don't know when it's going to turn, and you're always looking for that new opportunity. Yeah, unless you're meeting with everybody, you're never going to find it.
I'll tell you what, Paul Taylor, great to have you in the program. We'll do it again shortly. Many thanks for your time.
Thanks, Ross.